Everyone, thank you for joining us today to discuss the Intellect Design Arena Limited financial results for the third quarter of the fiscal year 21-22 ending 31st December 2021. The investor presentation and the press release has been sent to all of you and is also available on our website. Our leadership team is present on this call to discuss the result. We have with us today Mr. Arun Jain, Chairman and Managing Director, Mr. Prabal Basu Roy, Advisor to the Chairman and Director on the Corporate Board, Mr. Venkat Sarnu, CFO, Mr. Manish Makan, CEO, IGTB, Mr. Rajesh Saxena, CEO, IGCB, Mr. Banesh Prabhu, CEO, Intellect Seek, and Mr. Andrew England, Full-Time Director, and Mr. TV Sinha, CEO, IRTM. Besides, some other senior members of the Intellect management team are also present in the call. Mr. Arun Jain will brief you on the result, and this would be followed by Q&A, which will be replied by the senior members of our management team. Once the Q&A starts, you can ask a question by clicking on raise your hand, and we would unmute you so that everyone is able to listen to you. One safe harbor. I would like to remind you that anything which we say, which refers to our outlook for the future, is a forward-looking statement, which must be read in conjunction with the risks that company faces. With this, I request Arun to give his briefing. Over to you, Arun.
Good evening, everybody, for joining for this investor day, investor conference today. We met just 6 weeks back in Technology Day, where we shared with you the kind of progress we as a company making on the various technology platforms and how the tailwinds in digital space helping the company to get into a better traction which is there. So these results are validation of some of the elements which you have seen that time. So I'll just take you to the small deck of the presentation. So we are in a business of accelerating digital transformations by two ways, because of contextuality, composability, and cloud native, which is in the nature of the business is looking forward by the customers, by the customer. Today conversation, I'll take you to the Intellect, a snapshot, just a small repeat of what we presented on Technology Day, performance overview. What kind of deals are we winning? I'll take you to the digital transformations, what we are doing and what kind of deals we are winning now, and some observations. If you look at us, we are provide large enterprise grade, composable and contextual solutions, driving higher business growth, reducing cost and risk on sustainable basis. So Intellect is a company which has the ability to understand the complexity of top 4 banks or top 5 banks of any geography and intercept that so that detailed long-term relationship can be established by using the complete MAC solution, which is microservices based, API based, cloud native and headless. If I look at the slide, this is a slide which is known to all of you. We look at it, design thinking as a core tool for driving the last 2% is 200%. In financial sector, its last 1% is 200% because the kind of security frameworks, the volume framework, the high performing applications which is required is phenomenally required very intense R&D team. I mentioned to you last time, we built up a first technology stack with the 4 exponential technologies. Then we have a deep data model. And then we have a products, which creates a products. Then we host it on the cloud, which makes a platform. And then when we bring a third party participant plus fintechs, then it becomes marketplace. This is our journey going forward. So last 5 years, we are working on the same journey. We were in first 2 spaces in last 5 years. Last year, we are moving to third step. And then the final step will happen in next 2 to 3 years. What are the technology shifts that is favoring Intellect? There is a movement on premise to cloud, but may not be what we are observing. It may not be public cloud. There's a mixed feeling of the large banks that they want to set up their own cloud, which is a private cloud, but it's on a cloud. But their shift to open architecture is very, very critical. So API is a medium of data exchange, segregation of UX layer, business logic, headless architecture, MAC as a de facto standard, emergence of fintech and marketplace, and predicting trends and investing proactively. Why I'm mentioning these 7 elements? Because that is aligned to the previous slide, which is driving our growth engine. These are the 4 technology platforms which we call technologies. We built up a data platform. We built up a intelligent document platform. We built up a hyperscale banking operating system and Turmeric API ecosystem to give a unified data architecture, API-led design, cloud native, and configurable integration. So these 4 pieces are the core of our acceleration and the value proposition in the market. This drives us at least 30 to 40% reduction in implementations, and we are able to give a proof of concepts in a period of 4 weeks to 8 weeks. We are able to give a proof of concept to the customer, and this is leading us to shorter implementation cycle, and that's why the collection period has improved substantially in this period. These are the 12 product line where we deeply go into each product, writing a user journeys, which we have shared already with you. Most of the investors in this call must be knowing about these 12 products. And these are 4 platforms: iCredit 360, Cash Power, Exponent, and Gem. Now coming to the performance review of the quarter. I'm proud to be announcing that we could move from 22% to 33% on quarterly growth in this quarter and cross 5 billion mark, 5.08 to be precise, from 3.382 crore to 508 crore. In dollar terms, it's 31% growth. The gross margin has moved up by 39% year on year. EBITDA moved 37% year on year. PAT moved 25% year on year. Gross margin, which I mentioned to you almost 2 years back, we are inching towards 60%. So in an ideal state, our gross margin should be 60%. It reached from 56% to 58%. EBITDA has moved from 25.5 to 26.2%. Our directional goal is to make it 30%. Collections have really catapulted this quarter, which is 485 crore of the collections, which is leading to EPS of 30 rupees. The collection days has come down to 129 days, out of which global excluding India is 105 and India is 217. Over here, I want to bring one important data point over here for collection, that in a product business, there are certain revenues which are contractually not payable by the customer, and they become due on a contractual terms, and that number is close to 30% of this number of the receivable is sitting in where due, which is not collectible, and they will be collectible on milestone. So your company is zero debt, profitable global company with cash of 431 crore at end of the quarter 3. We break it down the revenue to next level. We are looking for SaaS and subscription revenue, which grew to 113%, moved to 89 crore from 41 crore. License revenue this quarter grew from 91 crore to 112 crore. And AMC moved from 74 crore to 82 crore on 11%. Now AMC 11% is linked to whatever the growth rate I had in 2 years before. So whatever the system has gone live, that becomes due for AMC. So that time our growth rate was around 15%. So AMC growth is around 11%. So AMC is directly proportional to our growth cycles, which is there. So in 2 years from now, AMC growth will increase appropriately. Investment in product development, they are remaining constant around 28-29 crore. We have won 10 deals during the quarter. I'll take you them. What are the traction we are having? There are 11 digital transformation we have completed in this quarter. On YTD, we grown 25%. On dollar terms, 24% in Indian rupees. We have given a guidance of high teens. We are able to deliver 25% growth as of now. Gross margins grew by 30%. EBITDA grew by 38%. My PAT moved up YTD 39%, close to 40% we moved our PAT during this period. Gross margin is 57.7%. EBITDA is 25.7%. And collection is over 1,000 crore is a collection during this period. And other data element remains same. Again, on a second level breakup, SaaS revenue grew 122% to 254 crore. License 278 crore and AMC is 243 crore. This is combined creating 57% of the revenue are license link revenue and 43% is implementation revenue. In this YTD in last 9 months, we are invested 85.9 crore in product capitalization. Deal wins is 29. Goal 9 again, and $28 million rupees is CSR contribution. Now this is an important figure over here when we say steady growth in license link revenue. When we started 5 years back, it was 33% was license link revenue, which moves very slowly to reach 42% in FY19. It reached 46% 20, 54%, and now we are inching towards 57%. Our goal for a good product company is to reach 2/3, 1/3 of license link revenue as we move forward in next 2 to 3 years. That's a cycle we'll look at it. Our pipeline is healthy. It's growing consistently quarter on quarter. It's 5,000 crore of the pipeline, where 159 deal alone constitute $565 million of the deals. These are the destined deals. So this is a shift we made 2 years back, that we moved from the average deal value substantially and we start focusing on destiny deals. So that was a shift 2019, which is driving the results today. So today we have 57 destiny deals. So these deals are which we have qualified. We are almost at, in our cycle of sales, it's a P4 stage. There are 54 deals in that stage. That is a kind of our ledger of the deal. So it's deal ledger, how we move the deals, which is more than 50 crore deals, moving from 8 deals to 11 deals in Q2 and 12 deals as of now, which is there. So it's a 50% jump on a large size deal. 30 to 50 crore is 17. And if you look at it, 20 crore to 30 crore bracket, there are 28 deals. So there is a significant progress from 42 deals which were there in testing deals last year at the same time. We are sitting with 57 deals which need to be closed in next 2 to 3 quarters. These are financial numbers you must have gone through anyway. I will not take much time on this. Now I'll take you to some taste of what kind of digital transformation we are doing. This I mentioned about it, that we have 12 composable and 4 platforms. And there are new digital transformation which we have accomplished using our suite. These are 40% faster than other players in the market. because of 300 fine-grained package business component, 900 APIs, and low-coded and accelerated predictable implementation technologies like Turmeric that replaces coding with configuration. So this is our secret sauce of transformation. If you look at it, what is the kind of wins we are able to have it now? This is a very celebrated quarter for us. We could able to win 2 new deals to penetrate 2 new banks in US, which is a significant celebration for us internally. Both have come in a space of a product called virtual account and escrow. So there's the new technology which we built on cloud in US, we launched in US. US is the most difficult market for us to enter, and you were asking the question when we'll be entering into US. I think 2 deals in a quarter. US is a substantial success. One thing I want to highlight over here on the cloud revenue, when we win this deal, there is a cycle time of between 3 to 4 quarters they will go live. And during that time, the cloud revenue start kicking with a revenue lag of 3 to 4 quarters. So even though we would have won these 2 deals, but there will be 0 revenue booking in this quarter on account of these 2 banks on a revenue bucket. So cloud revenue lag is one point I want to bring to your attention. Same thing happened for the SEEK revenue. We won 2 deals in Europe. The top 3 banks signed up for cash flow forecasting, which is a GDP liquidity management platform. And then trade platform has been extended for Austrian bank. Then we won 2 deals in APAC. One of the Vietnam leadership is continuing. We signed digital transaction banking for Vietnam. And similarly, we signed Capital Cube for one of the Oceanic Bank in near Australia. There are 4 deals in IMEA, India, Middle East, and Africa. Leading sector bank signed Intellect LIBOR transition in Capital Cube. We have a leading deal in Kuwait signed for the iCredit 360 platform. And there are 2 major deals in Africa which we signed up using partnership networks. So a lot of time you are asking me, how is a partnership network moving? Now this is a proof of the pudding that we are able to use partners to win these 2 deals in this market. And they are, one is a French-speaking customer. So it was difficult for us to reach there on our own, and partner enabled us. And that resulted into higher SG&A because of the partnership commission. So when we start using partnership more and more, our SG&A commission will go up. So that may be the reason. That is one question you might have, that why the SG&A has moved so much in that quarter to quarter. And the major reason is about activating the partnership network, which all love to have because that helps in growing the business faster. So this is a kind of a 10 different customers who are approaching Intellect for the transformation of digital platform they want to do. Now this is another important slide, that how did we complete the digital transformation, which becomes my referencing for the future deals. When I spoke to you in 2019, we said when we enter the new market, we need to wait for 2 years for the system to go live sometime, and then he start using after 6 months, then it becomes a referenceable account. So that's what become for each market. You move from stage 4 to stage 5. Now, since we have like in Americas, one of the top 5 Canadian bank has modernized their entire commercial banking channel with IGTB contextual banking CBX for payments. Now this is a very, very difficult job to transfer on corporate payments in a Canadian market. Today we have that credibility that went successfully live. It's been working there. Similarly, the GCP business IDC has gone live with another Canadian bank in less than 10 months from sign up the deal to go live in 10 months time. So these 2 deals are bringing credibility in America. we have a referenceability on our architecture that it works. It has gone live. In Europe, similarly, the trade platform, which is being written on the basis of newer stack, has gone live. So there are 2 deals over there. Then there is a 2 go lives there. Then there is a APAC. It is a very, very interesting deal. One of the Intellect cards, which is, we call it in a stage 3 product right now. We are not calling it stage 5 product. Has fully gone live for a Singapore headquartered bank who wanted to enter into Indian market with entire merchant onboarding, customer onboarding, complete card functionality. That will give us a access to the platform in Indian market. So this could be the 5th platform. We'll be looking at it in next 6 months after system goes live. Similarly, entire IDC went live in Southeast Asia, large bank where they will help transforming using microservice platform. We have look at it, a top 3 Philippine bank using cash power went live. Asian Bank went live in integrated digital transaction banking platform in Singapore and Cambodia. In India, major system on digital lending platform has gone live with one of the largest banks on the modern architecture. In UAE, we have again one more IDC event going live in this period. So if you observe, the IDC is becoming a next IDC and CBX, which are driving force, is getting momentum now because of the reference sites. And similarly, CBX in Oman. So this 11 reference sites and 29 digital transformation, which we did in the last 3 quarters, these 29 references have a word of mouth, and that becomes a pull deals rather than push deals. In our journey, when it becomes pull deal, it becomes much simpler to do that. In this period, what we have added, one is a partnership council we added agenda. Second thing we added is a strategic advisory board, which consists of 8 members. I discussed about this thing during the technology day, but I'll just repeat it over here. This is all the spaces of the financial industry. We brought in the strategic advisor from retail segment, corporate segment, and then certain market focus people from academics, finance, and there's a 8-member strategic advisory board. We could able to put it together. You know Andrew England and Prabal for quite some time, but Dave Revel, Pradeep Kapoor, Sanjeev Chaudhary, Sarup Chaudhary, Theodore Roosevelt Malloch, Vikram Sood are the members which created a strategic advisory board for Intellect. These are the small resumes about them. Dave Revel was a CIO of CIBC, and I think he brings not just a CIO flavor, he knows the latest technology so well, and he works with all the players in that market that he provides a deep expertise of Canadian market. Andrew England, all of you know, he's a master of transaction banking. He's working in Europe. He worked in almost every country in Europe, from France to Germany. I think all the countries, all the large banks, he gives an insight to us what kind of a product is required. Prabal brings finance strategy. Ambassador Pradeep Kapoor brings a lot of presence since he was ambassador, retired, and diplomat in many countries. He brings huge amount of ability to work with the central bank areas. Sanjeev Chaudhary, I don't know how many of you know, he's a chairman of IDFC First Bank. And from Intellect perspective, he brings in the kind of a marketing genius what we are looking for in advisory board. Sarup Chaudhary brings a partnership kind of flavors to us because he worked with HSBC, IBM, Thomson Reuters, First Data. He brings that kind of capability. Now, Theodore Roosevelt Malloch is another academician. He taught in Yale, he taught in Oxford, and through which we are building a brand, IGTB Oxford. He brings a lot of capability. Just to mention here, I think he's connected to the Roosevelt family of famous Roosevelt. Vikram Sood has a great experience on operations, large operations. He handled Kotak operations, and then before that, city operations. A large multi-location operations. So when we are talking to the customer on our value for their operations, he plays a critical role over there. So this 8 people strategic advisory board is already set up with us. So with that, I finished my call here, my conversation here right now with you. I can open this session for question answer at this point of time.
Thanks, Arun. Now you can ask a question. Please click on the raise your hand, and we'll unmute you, and then your question will be replied by the management team.
Yeah, so I'll just respond to Praveen. I'll just respond to this question: why there is a regular drop in promoter holding? There's no regular drop. Promoter has not sold a single share in last 2 years, last 5 years, since we have taken. So which data is there? Maybe if you type it out, it will be good.
Okay. So the first who has raised the hand is Baidik Sarkar. Baidik, you can ask your question. Please unmute him. Baidik?
Yeah, gentlemen, thank you very much. Arun, hi, good evening, and congrats to you, Manish, and the entire team on a great quarter. Couple of questions. It looks like now roughly 80% of your incremental earnings are from SaaS, right? So I'm just trying to understand the characteristics of your SaaS incomes slightly better here. For example, between Q4 of last year and Q1 of this year, our SaaS revenues, incomes were up roughly 21%. And then again, between Q1 and Q2, we were up 13% sequentially. And in Q3, we were flat, which is all right. So what's the right metric that you use to gauge the build-up on your SaaS revenues from here on? I'm assuming they're an ideal combination of the amount of credit and insurance you underwrite plus the installed user base. So how should we read that, A? And B, how should we understand acceleration of SaaS from here on?
Yes, SaaS is still evolving, Baidik. Let me be very honest with you. I also cannot judge this, and we always struggle in our management room. How do we really estimate the SaaS revenue? Though we have a inkling, I can share with you what is my understanding of it. But since it's the enterprise grade cloud revenue and SaaS revenue, it's not a retail where you can say so many leads and so many leads are getting converted. In our SaaS revenue, the deals can be very large. So our SaaS revenue could be as large as $2 million on an annualized basis. Like typically SaaS revenue, when you're talking about in a small company, it will be $20,000 per customer. We have a per customer revenue pool could be as high as 1.8 million to 2 million. So typical customer will be between $250,000 per annum SaaS revenue to going up to 2 million to 3 million per year. So that's where there's a predictability numbers on cloud are there. And normally when the deals start happening, customer initially asks for a license, then he shift to cloud, then he shift back to license. So these kind of fluctuation also does happen. So what we need to celebrate is that we are growing, doubling our revenue in cloud year on year. And we have sufficient deal, whether it will flow in as a license or it will flow in a cloud. I think license link revenue is a common index. If you can look at Baidik, that will be a good index for you. My ARR today is 684 crore and license link revenue is 57% of the revenue. That is a right metric for us to look at it from an investor perspective.
Sure, I understand, Arun. That's very helpful. It clarifies a lot of our questions. Moving on, there's a phenomenal traction in the sequential license wins, right? So is the breakout here a function of pent-up demand in decision making, Or is it just organic given how the transition to digital is? And if I could just kind of invite your comments on the 57 deals that you highlighted will close over the next 2-3 quarters. Is there a quantum value here that you'd probably like to say is a right to win? And just put a number to that.
If you just do the pattern analysis of last few quarters of when we are publishing this deal ledger, every quarter out of these decisions which is there, some gets postponed, some gets taken to the next year, budgets get postponed. So there's a pattern there that we typically win. Out of this 4 deals in this quarter we won, we lost 1, added 8. And if you just plot it over the last 8 quarters, we are winning around 4 to 6 deals in a quarter. Now, our science of knowing those deals, resale processes are becoming more mature in the organization, where our win rate is increasing. Once the destiny deal is there, our win rate is over 60% on those targeted deals. But if customer postpone the deal, then it delays out. So our win rate is now 4 versus 1 loss is close to 80% win rate. But that's not a right way to calculate. I'm saying 60% we are able to win when we put our focus on winning.
That's very helpful, Arun. Congrats again, and I'll be in touch. Thank you very much.
Thank you, Vaidik. Next is Mr. Mayank Babla from Dalal and Barocha. Mayank, please ask your question.
Thank you for taking my question. Am I audible?
Yeah. Please go ahead.
Yeah. Congratulations on a great set of numbers. So my first question is around margins. So our vision is to reach 30% EBITDA margins. Could you give us some sense of the operating levers that we have at hand to see this sort of expansion?
Yeah. So let us see the anatomy of the margins what we have. I think we book RSU cost, which is as per IFRS, which comes to 2% of the IFRS costs. We are not talking to you earlier, but now that cost over the period of time and the RSU are getting issued in the company, that cost is it's an intangible cost in your books, but it's a cost in your books. It comes above EBITDA. This cost comes above EBITDA, not below EBITDA. This is not another cost. It's an employee cost or a SG&A cost. That's a one part of 2%. 46% is there, 2% is that. But the question over here is that in this quarter, when we are building a partnership network, we were looking at absolute number more than this. Last quarter, we said we should focus on the growth than the margins. So we took a call. So in this margin call, 2 places where we invested the money. One is we increase our headcount by at least 400 people during the quarter. This is for preparing the company for $75 million quarterly run rate, which earlier we were $60 million run rate. To move to $75 million run rate, we need a capacity. So we did a capacity enhancement. And second thing we did is we leveraged the partnership network, and that commission cost has gone up in this quarter. So it's a 30% can be achievable. It's just a matter of any quarter will be good enough quarter in product company. The benefit is that we can't sequentially product. This time we never look at it that 33% growth. If you would have seen 33% growth, I would not be saying high teen margins. So there's a lot of deals in the pipeline which we can't predict and how it will move. You will find within the next 3-4 quarters, suddenly we'll move to that needle will move there.
Okay. Sure. And so my second question was around this capitalization of investment in product development. So around 28-29 crores per quarter and 85-86 crores per Y2 as per YTD. So could you guys just give us some sense of where is this capitalization? Which product are we investing in, or could you give us a breakup of this investment in which products we are focusing on, and how we can expect this to span out over the next 2 to 3 years?
Yeah. Since you may be new to the product business, I think their technology investments are quite high when we are moving to cloud. We are investing 12 products and 4 platforms. So all the platforms need a constant upgradation. The technology changes so fast that we need to make it just to remain there, you need to invest. And every product requires their roadmaps. So this 120 crore, we invest close to 220 crore. And we write off 100 crore in the same year, which is around just version upgrade. But where we invest the major money is in the product where we are making them ready from India to Middle East or Asia Pacific, then ready for Europe, then we're ready for America. Every time when we move the geography, we need to invest in the same product like IDC, lending, credit card, liquidity, DTV, trade and supply chain finance. So all the products require market when we are positioning a product in a market, as well as we are building the product for next generation technologies.
Okay.
Mayank, also, just add to what Arun said, in terms of your first question, you wanted to know the drivers of the margin profile, etc. So I'll give you another cut on that. And you'll be able to link it because you see, there are three tailwinds which are working very much in our favor at the moment, and they will continue from what we can see. The first is, of course, as he mentioned, our change in approach to going towards more destiny deals. So the deal sizes are increasing by itself, by definition. So that is one big lever. The second big lever is with better branding and more acceptability and referenceability, the pricing obviously is on the upside.
Okay.
And third is the issue of revenue mix. If you have seen our financials for the last, let's say, 16 quarters, you would see that the license-linked revenues are now much more than the implementation revenues. So 60-40, now it's just the other way around. So the confluence of all these three things, which will obviously continue as we expected, are the real strong intrinsic drivers of the business from a margin profile perspective. Yeah.
Sure. Thank you so much. Thank you for answering my questions.
Thanks a lot, Mayank. Next, we have Mr. Mohit Jain from Anand Rathi Securities. Mohit, please ask your question.
Yeah, sir, I have two. One was related to deal addition. Like in this particular quarter, the addition seems to be a little on the lower side while pipeline is up. So if you could help me understand what kind of, is it more like seasonal or do you think more deals are likely in the next quarter or so? That was one. And the second was related to headcount. You specified there was like net addition of 400 staff during the quarter. So where is the total count now versus, let's say, 1 year back?
The total count is, we don't announce the headcount number because product companies are not measure the headcount, but just the 400 is an incremental headcount. So it can come on to 8 to 9% increase in the headcount, which increase partial cost in last quarter and partial cost in this quarter will be added to all because of salary in that particular area, Mohit. About the
so you would be like closer to 4,500 or you would be more closer to like 5,000, like any ballpark range will also do.
It's okay. I mean, it's closer to, it may become closer to 5,000. We were running around 4,000, closer to 4,000, lower end of the 4,000. It may be closer to, may go to closer to 5,000 by 31st March.
Okay. And sir, on the deal win side, like.
A deal win side, I think this is we can't track quarterly basis. I think it's just each product by product we are tracking. We are creating a tough criteria to be qualified as a opportunity. So we are moving the gate from, we have 6 stages of the deal. One P0, which is a lead awareness. P1, which is where customer has seen the demo and he liked the demo, and then we move to P2 when we are given a multiple conversation with the customer, and then he requested for the proposal. When we requested the proposal, is P3 stage. So when we are showing this funnel, we are showing the funnel after first 3 steps are not even included into this funnel. $675 million doesn't consist of any
Sir,
of
I was referring to the deals won, like absolute number of deals won.
10 deals. You're talking
Four Destiny deals that you have announced in third quarter. Like last few quarters, we were winning at 5, 6 kind of a deal. So what I was looking for is like pipeline is up, deal count is little down. So what should we expect like going ahead?
Yeah, I didn't track it this way. I didn't look at the way you're looking at it. This 4, 5, 6 are just the numbers.
I think deal values are increasing. If you look at the larger deals are closing.
Okay. And sir, good quarter from all counts. So congratulations. But I had one point as well. Your disclosures are going down every quarter. So now from this quarter onwards, I'm not able to figure out any number on the advanced market as well. So, and there is no currency segregation also. So how do we sort of track it apart from the management commentary?
Yeah, we are just looking at it. These numbers, does it make sense to anybody? Because so many currencies are there, some 2%, some 3%, whether it makes difference to investors.
Sir, even the key ones like USD, Euro, there are major currencies, right? INR, at least top 5 or 3, 4, we can disclose like every other IT company does. And we are also approaching $300 million as you specified in the comments. So,
sure, we can publish that. There's no big issue about that. That's just a matter of that whether the slides are valuable to the investor. When we are looking at a global investor presentation, we are finding that it's not significantly valuable to the global investor. So that's why we not publish it, but we can publish it. If you want, we can also circulate it afterwards.
That would be really helpful, sir. Thank you. That's all from my side.
Thank you, Mohit.
Thank you, Mohit. Now we have Mr. Ankush Agarwal from Surge Capital. Ankush, can you please ask your question?
Yeah. Hi, team. Congratulations on a very good set of numbers. So firstly, I want to understand the whole receivable cycle of our business a little better from a basic understanding. So like say if we make a 100 rupees deal, right? Of which say assume rupees 50 is license, rupees 50 service and implementation, right? And then we get say 10 rupees as AMC after the implementation is done. So at what point of time will we book each of this revenue segment separately? Like when will we recognize it, when we will bill it, and when will we actually get it? So like for example, if the deal is signed, do we book the entire 50 rupees of license revenue upfront? And does that get billed upfront and is receivable upfront, or it is recognized upfront and then is billed at a later stage once the implementation is done? So basically trying to understand this because if I look at our unbilled revenue, those are like twice of our billed revenue. I just want to understand which are these revenue streams which are contributing to such high unbilled revenues where we are booking the revenues but we are not actually collecting.
That's right.
If you can help me understand that better.
Let me take a step back. I think this is a question which is asked by many people. In a product deal of 100 rupees, if you take an example, 50 rupees license and 50 rupees implementation. Let's take this example.
Yeah.
50 rupees. There are multiple methods of booking the revenue. Method 1, when the deal is clearly when license is separated from the implementation and license is delivered on the day of signing the deal, 100% revenue gets recognized into books of account. There is a second type of deal where revenue gets recognized with a proof of completion, because in a contract, customer says that he'll make a milestone-based payments and milestone-based deliveries, and its multiple stages are there in the product. So there we build and book the accrual on a as and when the project is getting completed, and proportionate license revenue will be booked, which is called proof of POC, percentage of completion basis. That's the second kind of deal. Third kind of deal is a cloud deal where we sign the deal, we set up the cloud for him, and we'll be billing when he start pay per use. Is the third deal. There is a fourth deal which happens where we have the revenue, which is this is a 7-year deal, and 7-year deal licenses are there, and we book the revenue based on amortized we will be doing a subscription. We'll charge him on an annualized basis. So we'll say 1,000 rupees for 7 years. I'll charge you 130 rupees per year for 7 years. Now, this is a method given to the customer to make a payment on an annualized basis. Over there, our auditors look at that number saying this deal value is for 7 years, which is written signed contract, but it's only the payment terms are different. You book the full license revenue upfront because you have delivered the license to the customer, and then look at the 20% AMC on it and appropriately adjust it. So there are 4 kind of deals which are happening in a marketplace.
Right.
Now,
so just on clarity. Yeah. Sorry. Continue.
Go ahead. You ask a question. It's okay.
Yeah. No. So on the first deal, when you said that license component is separate and implementation is separate, so in that case, we'll book the entire 50 rupees upfront, and that is billed to the client upfront as well, right?
That's billed the client upfront.
Right. And implementation as a base of percentage. So on the unbilled revenues, which is the most dominant component? Like it might be the implementation, I'm assuming, right?
Yeah. So payment terms are milestone based. So that's why the unbilled revenue, a lot of it is after they pay the license revenue, they will pay after the UAT. So there's a long cycle gap. If it takes 6 months to implement, then when you're doing the completion, the money will go into the accruals, which is not billed. It's because it's not due.
Right. Got it. Right. And so secondly, in our services revenue, you had earlier talked about this hypercare support, right? Which I believe is kind of a recurring component. So can you quantify that for this 9 months?
Hypercare support is after go live.
Right. No, I am assuming that the implementation revenues that we have, some part of it is the hypercare support revenue, right? Which is a recurring revenues that we get for getting our support team available at the client's place to manage their implementation. This is after the implementation is live as well, right?
So we try and keep most of the hypercare on a monthly basis.
Right. So I'm just trying to understand what is the quantum of that revenue.
It's not as significant. I think total implementation revenue is 43%. That will be another 3, 4, 5% maybe.
Yeah.
Right. Okay. It's just 3, 4, 5%.
This is not a significant number for us to track. Our tracking focus is license link revenue is the tracking focus of the man. Right. But one more thing I want to highlight to you in this unbilled revenue, there are 2 things which are there, which is increasing our days in India. In GEM, government marketplace, we have a contracted, which is not due, because my payment from GEM becomes due when buyer updates a system that his sales order is fully closed. So I get 25% upfront, rest 70% is sits into unbilled revenue till the time buyer updates a system. Buyer might have procured the system, but he has not updated the system, my revenue gets stuck there. So I have a close to 400 crore sitting there in a bucket of 600 crores, which is increasing my number, which is, there's no delay from the payment from the government, but there is a contractual issue because still buyer is not updating it. There's a laxity on the buyer side. He doesn't update the system.
Right. So broadly, just the understanding is that in our business, for the accounting terms, we are able to recognize the revenue, but because of the contractual terms, the actual billing takes place at a later stage, which is what feeds the entire higher DS, right?
That's right. Exactly.
Okay. Got it. So that was very helpful. Thank you.
Thanks, Ankush. Next, we have Mr. Vivek Charoria. Vivek, please ask a question. Unmute yourself.
Hi, sir. Thank you for the opportunity. Sir, as you said that we've added about 400 employees in the current quarter, are the costs mostly accounted for in this quarter, or should we expect some more cost increase? Because our pre-EBITDA cost has gone up from 340 to 380 crores almost. And I'm guessing the quantum of increase won't be to the same extent going forward. So should we expect the cost to stabilize at a certain level?
Yeah, the cost will stabilize to some level. but for 400 people, cost is not fully taken in the last quarter, because they joined in November, sometime in December. So the only partial cost of those months are taken care of, and few more are to be joined to build the capacity of $300 million. That's what we have capacity is built up. So employee costs will go up, sales commission may come down. So as of now, the cost increase of 340 to 380 crore. There's a cost increase on the delivery side, and there's a cost increase on SG&A side. So SG&A, there is a substantial number this time. Depending upon how many deals which we are using partner-led, that number will fluctuate. So some costs will go up.
Okay, all right. Sir, on the growth prospects, obviously we've grown very handsomely this quarter. Should we expect like a 5 to 6% quarter-on-quarter run rate, or as a management, are we not able to predict? We talked about hitting 400 million in the next 3 to 4 years, but given the way we are growing, do you think we are more sanguine about our growth prospects? Can we do better than the 20% that we've hinted at in the past calls?
Yeah, obviously, we reached 25% this 9 months period, so that's a good number from 20% to 25%. So my answer to that is we calibrated the organization at 20% growth on the top line and 30% on the EBITDA line. That's a business calibration. I'm repeating this answer multiple times. Sometime we'll get some deals on a year, sometime we may not get the deals. So the fluctuation will happen between 15% to 25%, and few years can be much better if the traction starts. So if we get let's wait for a few more quarters. But for investor perspective, if the 20-30 is a simple formula, so could be much better for us to look at it from a design perspective.
So just one more. So do we track cash flow internally? Because I think the market looks at it very closely. So in this quarter, our collections have gone up quite handsomely. Is that something that we track with a focus internally? Because in the March numbers, that number can vary quite a bit if in some quarter there's a dip.
Yeah, again, there's a milestone-based collection. So when we raise a bill, so if you look at it, our DSO for the bill is less than 30 days. So all our clients pay within 30 days once we raise the bill. So that is not a major concern about our financial institutions, which is there. But sometimes many projects goes live in a single quarter, and you have a bulk payment comes out of that, or some license gets signed and advances come for that. So that's where the quarter-on-quarter making the projection looks difficult for us to look at it. But in year-on-year, the detailed focus is there, but every deal is very, very highly focused. Now our implementation cycles are coming down. Earlier implementation cycles were 18 months to 24 months. And now we are looking at implementation cycles are coming down to 6 months to 12 months. That is also helping us out in bringing better collections in the system.
And Vivek, in terms of just, because you have been an old investor, from the very, difficult days of, let's say, 2018, when you guys obviously had questions on the cash burn and so on and so forth. So we had said a lot of things which we are going to change, and they are now evident in the results in hindsight. And one of them was exactly this, that we will change our approach to our capital dilutive approach. We will change that. We took a stake on the ground and actually said that, right? At that time, we will not raise capital. And therefore, we will move from a P&L driven company to a P&L plus operating cash flow driven company, both of them. So that is the mix. These are very fundamental changes in the organization, which has transformed us to where we are today. So that will continue. I think quarter on quarter, the exact number, obviously will fluctuate here and there, but on a positive cash flow basis and non-capital dilutive approach, those are the pillars of the transformation process which we went through. And you would understand that because you've been there for the last so many years. So.
That is very helpful. Thank you so much, Prabhu.
All right.
Thanks, Vivek. Next we have Mr. Anil Sareen from Centrum Wealth. Anilji, please ask your question. Anilji, please unmute yourself.
Yeah, sure. Sorry, I took some time. So first of all, congratulations. Am I audible?
Yeah, Anil sir.
Yeah, great. Great show, and I do recognize that there can be quarterly variations, as Arun has pointed out, that Sometimes you get more deals, sometimes you get less deals. So don't get too excited or too depressed on a quarterly basis. Well understood. I just wanted to know that, earlier on in your earlier calls, you would talk about developed markets or advanced economies versus developing economies. So obviously there is a trend. We are going more and more towards developed economies. What is the figure for this quarter?
The figure is now what happens, Anil, when we begin of this year, we have started seeing the digital transformation agenda is digital transformation. Digital transformation can happen in HDFC Bank or in developed market like America. Both are of similar nature. The nature of digital transformation has changed substantially. Earlier, the product business was very different in nature, where Indian customers are not willing to spend that much money. We are finding today African customers are willing to spend the similar money as developed market customers. But developed market helps us out in expanding the expectation right, our artificial expectation right. So we are now winning the deals of 100 crores in a developing market versus developed market. So that's why our management team has looked at it that now there is no point of looking at it whether developed market or developing market, and we should not look at our engineering teams, our organization to be saying, oh, you are working for developer market and I am working for developing market. So it creates a caste system within the organization. So we stop looking and comparing those two deals. We are saying any customer who is looking for digital transformation and complex enterprise grade digital transformation, we are the right vendor for that. And that's why these matrices are not diluted from the investor perspective.
Okay. Thank you. That's helpful. Another question I had was, you did 2 technology days last year, one I think in March and one in December. So, I mean, that was unusual. Normally companies do once a year. So obviously internally, top management is feeling, that we have crossed some milestones as far as technology is concerned, and hence 2 technology days. And don't get me wrong, I really enjoyed. I have sort of replayed some of those, because first time you don't understand. So it's very impressive. What I wanted to know was, there is this fintech onslaught upon the banks. Banks all over the world are feeling the pressure that, certain parts of their business are getting nibbled away by nimble fintechs. Now, when you spoke in your most recent technology day, you mentioned that a bank which is similar to Bajaj Finance in terms of its character research, has sort of chosen you over multiple other contenders. So essentially, if I were to take it one level higher, you are enabling banks to fight the fintechs at one level, and second is that, are you also enabling e-commerce oriented players to sort of acquire bank-like characteristics? So I'm asking 2 things. One is defending the banks against the fintechs at one level. And second, there are e-commerce players who say, no, we can do buy now, pay later. We can do this, we can do that. So that again becomes a target area for you. And is that correct? Is my understanding correct?
That's right. Rajesh, you can comment on it.
Yeah, thanks, Arun. I think let me take the second part of the question first. I think you very rightly said that when a couple of quarters and years back, we would look at only financial services as a core target market. Last year, we announced a deal in Germany, which is the second largest e-commerce player in Germany, Otto. And there we talked about how we are helping them build the payment ecosystem. So I think that's something that we are specifically focused in Europe market to look at an e-commerce player and enabling e-commerce player to create that payment capability. So we sold a very large deal to Otto last year, and we announced that in the market. So I think that's one. Regarding fintech, I think we are doing a combination of both. We are helping banks, for example, in one of the Middle East banks, which is right now under implementation. we are doing what we call as a super app, where the bank is tied up with many multiple third parties to offer products. I think we'll be shortly announcing going live of that, right? So we are helping banks to collaborate with fintech players as well as fight fintech players. So it's a combination of both. And e-commerce, yes, that's a new target market that we are looking at.
No, thank you. Just to follow up on that. So, I mean, when I look at you, I mean, the kind of the diverse offerings that you have and the target markets are very large and fast growing. There one feels that, I mean, with such kind of sophistication, one needs to be much bigger. When I look at other, like Finastra or some of the other people, they're so much bigger. So what am I missing with this kind of a cutting edge technology that you possess? Why aren't you much bigger than what you currently are?
Those companies are just as Finastra, you have given an example. These companies are not built organically. They are built on a platform which is a merger and acquisition platform. So I think growth at 20%, 30% growth is a very sustainable growth and calibrated growth, because banking is a complex market. We cannot make any error. The way the brand has to be built is zero defect, the security architecture. So I think we can grow better. Maybe our 12 products are there. If each product does all the products come to stage 5 quadrant, or even 50%, 6 products come. As of now, 3 products are in stage 5. If 3 more comes in, the growth rate will accelerate. So we are not controlling the growth rate. Potential is there. Let's see how it is panning it out. As you rightly said, we have composable technologies. Because of composability of the technology, we can apply the same technology for e-commerce player, we can apply the same technology for financial institution, and we can apply the same technology for banking institution and fintech organization. Because it's like a back room of me. It's like a Honda back room. I created a one chassis on which I can do a multiple model design on the top of it. And that's the beauty of Intellect technology architecture. And that's why we wanted 2 technology days, because I think the technology are changing so fast in business that investor needs to understand how the technologies, we are applying the technology in the environment. Did we expect 33% growth in this quarter? No, we never said that even in the month of July or October. I never said that we will be growing 33%. But it was a good surprise to us.
No, what I'm saying is, like that day, Banesh's team was talking about, basically disrupting the whole underwriting process. And I mean, it was so impressive to see. So what I'm saying is that you people should be sweeping the market with this kind of technology that you have.
So, I just want to add to it, Anil. While I did talk to you about it, I think what we are seeing is that there has been a lot of effort over the last many years on the channel front end side. But when you actually look at it, there is a lot of change that's beginning to happen with existing large institutions with legacy platforms on the back end. They have to refresh and change the back end, because otherwise they don't get the agility they want for digital transformation. So what is happening, for example, I gave you the underwriting example that would actually apply to many other businesses that we do, where we are actually changing the core back-end platform for customers. But we have to do that, like Arun said, with a very zero defect, with a very high level of, security and capability. And I think to do that, sometimes we have to modernize these platforms in stages. So I think the bank is also coming to terms with trying to understand their ability to be able to implement change in their organization across the broad spectrum of products that we have. Now, we built this composable platform across products where they can start with something and keep adding other capabilities on top of it. Now, I gave you the insurance example where my main competition is still the old legacy policy admin systems. I'm actually taking underwriting out of it and actually trying to therefore change and digitally transform the insurance business away from their old legacy platform, because they can't manage those back-end platforms as easily as today we could offer them, in our cloud sort of composable architecture that we talked about on Technology Day.
No, great. Thank you so much. I think I have used up more than my quota.
Yeah.
Okay. Thank you so much.
Thank you. Thanks, Anilji. Next, we have Mr. Manish Dhariwal from Fiducia Capital. Manishji?
Yeah. Good afternoon, and thank you so much for this opportunity. I have been, associated with this organization for the last maybe a couple of years now, and I'm also, participating in the way this organization actually is flowering. I go back to 2014 when you had taken the decision of demerging it from the original Polaris company, and then you had that vision that I want to basically make a product company, and obviously it has been a very eventful journey, I would say. So see, a lot of it, Mr. Anilji in the previous question also shared. See, what we understand is that today Intellect has been able to create a very huge bouquet of products, and each of these products are, the mega products in themselves, which can, when we look at the segment-wise competition and the big companies in the global markets, we say that they are like multi-billion companies. And here we are in our organization, we have so many diverse products, and also we are a product company. So there the growth again is not a percentage basis, it is the growth goes in a different progression. So if you could just kind of give us a flavor of that, when are these diverse verticals that we have, meaning what is holding us from all of these products. We are across the world, we are in 97 countries. So why is it that that we are still so small? I'll again repeat that.
That's we all want to be big, so including you and we all wanted to be big. I think we need to calibrate and step-by-step approach of looking at it. We don't want to make any accident, I mentioned to you. We want to calibrate. The simple process for you to understand, we say we have three leadership quadrant product. Leadership quadrant means stage 5 product, which is a stage 5 where we have a referenceability, we are best in class, we are last 2% is 200% has been taken care of. Now these products are giving a very high deal wins. Now we are looking at the next 3 set of products which we want to bring into the stage 4 to stage 5. That's it. Like payment system going live in Canada. Makes us credible in US. VAM, escrow getting into US. Once they go live in US, it becomes credible. So they move from, VAM will move from stage 3 to stage 4 now. But stage 4 to stage 5 will be the only when it goes live in US, because people wanted a local reference in the country.
Correct.
So more products goes into out of 12 products suite which we have. Now the simple equation is that why shouldn't each product do me $20 million license revenue per year? It becomes $240 million license revenue. Simple math from your investor perspective can be this. But no. So, and the same math as a CEO, I will have the same math for my leaders which are running. So there's no difference, it will be there. But it's a question of journey. When you're at stage 3, you will do $3 to $4 million a year. Then you are at stage 4, you will do $7-8 million a year. Then you are in stage 4, you will do $20 million a year. So stage 5 product will get $20 million a year, maybe. And then the market scenarios are there. Sometimes market is hot, some market is poor, budgets are there, budgets are not there. So those years of the drought can also happen during this journey of $20 million license per product. But that potential is there. The point is, since you supported the company for so many years, I think that we are excited about it. We have built up a design thinking culture of delivering the products so beautifully. There's a huge opportunity for all of us to enjoy this. India leading fintech player, we say 8012. Why do I call it 8012? I don't know. Did I share it? I always believe that the financial technology of the world should come from a latitude of 80 and 12 degrees. That is the latitude where we build the financial technologies of the world. When will that happen? That's a kind of a conviction we have in 2013 when we set up a design center that we will be building the financial technology. Few people believed in us, few people didn't believe in us. It's okay.
Fair enough. No, thank you for sharing these insights. Can you also tell us as to, how is this 100 crore AIF fund that we had set up? Meaning, how is that shaping up? And what opportunities is that bringing to us?
As of now, it's a legal process going on, application filing, SEBI approvals. So it's in that stage right now. Nothing much has.
But what's our vision? How is it going to be helping us in our development as maybe a mega organization?
That's right. So that we moved in this, if you look at slide number 4, where we say technologies plus data, product plus cloud, platform plus fintech players and associated company, marketplace. And that marketplace, so as soon as in next 18 to 24 months we move towards marketplace, that time AI fund will be effective there. Last time people have misunderstood this AI fund in that we are doing something tomorrow or day after. I mentioned clearly in the last message that it's a part of the 3-year agenda which we are setting up now, and it's not a hurried situation. It's a question of some technologies, spaces where we have a white spaces. We like to invest in them to the AI fund so that we don't have to invest our own R&D dollar in driving those technologies. We will take minority interest in those companies and leverage those technologies for our marketplace.
Okay. Wonderful. And so how is our GEM opportunity kind of bringing us, meaning where are we on that? Meaning what kind of revenue build-ups happening there?
Okay, so let me clarify. I think GEM, a lot of questions could be there. So I think some of the investors I'm seeing they are going to the websites and looking at the order book numbers. I want to clarify those order book numbers are bid numbers, not order book. Bid numbers, when the customer bid it, that get published in a website of 1,76,000 crores, which is done. So a lot of investors are calculating how much is the GEM revenue, and most of the revenues are maybe coming from GEM. That's not true. Our GEM growth is happening very well. A lot of adoption is happened in the market. Substantially, buyer market is getting adopted. Government is now we built up a credibility that IAS officers lobby are saying this is the best way to purchase. It's reducing their cycle time of purchase from 6 months to 2 weeks. And they are committing themselves because they don't have to go through any government process of purchasing, which they were earlier so much difficulty to purchase. So that momentum is happening on acceptance of IAS lobby of bureaucrats to accept this is the best platform to have. So our technology teams have done phenomenal job of wiring the GFR rules, government purchase rules. There are hundreds and thousands of those rules to be embedded into GEM, and that's a complexity which has been put together in a GEM. So the growth is natural, but our revenue is, as you know, if any system like that, it will be on linked to the volume discounts. So up to 50,000 crore, there is a one discount value, one value we get. After 50,000 crore, we get second value. After 100,000 crores, we get third value. 150,000 crore, we'll get fourth value. So the average will come down from a perspective of revenue realization, which is fair from the deal perspective, because our efforts also are lesser when the volume goes up on the platform. So that's a current system, but we are delighted to see that it's making a difference to India.
That's wonderful. But in terms of billing to us, meaning is it like it's a quarterly billing, or meaning how is Intellect getting the revenue or the income from this particular initiative?
It's a transaction basis, a basis point on the order book on the system.
Okay, wonderful. Thank you, sir, and all the very best. So let's we're all awaiting, how we become a mega organization ourselves.
Yeah.
Manish. Yeah, just 1 minute. Praveen, just one second.
Yeah,
See, Manish, there is one question which you're obviously a very perceptive investor, so and this will help also understand the AI thing in a different perspective, and which is very important, which has been central to our thinking. So Arun mentioned about the ecosystem, right? About going from products to marketplace, and all of that, for which you need an ecosystem. Now, let me give an example which you can touch and feel. For example, as we grow, we need, let's say, a fingerprint recognition system, for example. Now, we don't necessarily want to build the capability for that, right? So we could either buy out a company, which is the Wipro's, string of pearl strategy. So they keep on buying companies, or we could take a stake in a company for a much lesser value of cash outflows, and then still direct the company towards, enabling our ecosystem, right? And if you link it to the answer I gave some time back about the capital allocation thinking of the organization, this is essentially a very efficient way of allocating capital and getting the same benefits. So that is the thinking behind all of this. And this is obviously a medium-term thing. It won't happen immediately, all of that. So instead of buying out companies at a certain cash outflow to the organization for a much lesser amount, we'll be able to influence an ecosystem as we build it. So two very different strategies, but essentially on the capital, efficient allocation of capital is the driving force behind it.
Okay. Wonderful.
Thank you.
Thank you.
Thank you, Manish. Next, we have Mr. Rahul Jain from Dolat Capital. Rahul?
Hi. Thank you for the opportunity. Just two quick questions. Firstly, if we follow the total count of the IBS deals, which they usually publish in their annual survey, we have seen that there is not a significant increase in the total number of the deal, and it's been hovering around that 350 number, plus minus 20, 30 for last many years. However, we have been consistently growing over this last 4-5 years, which means it has come at the cost of winning more market share. So when you think this might come as a constraint for growth for you, are you seeing there is a significant improvement in market expansion as well?
Rahul, we are not touching any limits as of now. We are just, if you have a 12 product with $250 million revenue number, none of the product is taking a $500 million market share. So that is not a constraint right now for winning the deals in the market. The percentage of deal is important, coverage is important. Many markets we are present, very skeleton presentation. When we say 93 countries presence, we are not really present in 93 countries. We are present because we have implemented the solution. We win the deal there. We may be present to the partners there. So I think our investment in each country by country, that makes a expansion of the deals because of the superior technology.
Right. And
I think, Arun, just to add to what you said, the other data point, Rahul, to look at is, look at the same what analysts are saying, buy versus build, how the buy percentages are growing. That will also give you another aspect from a third-party independent source. So the market is expanding from that perspective for the product business and the platform business.
And Manish, any number you or Banish can throw in terms of what?
I presented for commercial banking in my technology deck. You can look at it. I can send it to you also.
Yeah. I mean, my question was in terms of percentage growth. Is there any expansion in the growth of the market that we are looking at?
No, that's what I said. Now the buy versus build is growing. That's a data point for you to look at. That for us, the space is expanding from that perspective.
Okay, understood. And secondly, specific to US market and also in the light of these two deals that happened with one with Wells Fargo and JPM, possibly with Encino and Thought Machine. So were we part of such opportunity? If not, why not? If yes, what was the experience?
Rahul, let's keep working on it. We are doing few deals, which is more than over $50 million deals. I think management has only finite bandwidth to take care of it. So we have to choose our battles. So, and the Thought Machines and these deals of a new fintech world, we are the only they are not profitable company. We are the only profitable company in this space with generating a decent margin of 26% EBITDA net cash into the company. All these companies are buying the deals here. So we don't know the contours of these deals of JPMC versus Thought Machine, whether who is invested where and what kind of stake elements are there. So I think we are a straightforward player. Keep contributing in digital transformation to the banks and keep working 20-30% growth year on year. I think let's not build up over expectations from the team, but it will be consistent. In one of the conversation I mentioned, I got inspired from HDFC. The consistent performance, I love it compared to any very high performance. So that's what story we are following right now.
Right. And just lastly, if you could share more thoughts. Of course, you have alluded about two North American deal which has helped your visibility significantly in the North American market. But in general, overall sense, product-wise or market-wise, and our opportunity, if you could share that how that market is playing out versus what it was, let's say, a year or 2 years ago.
Yeah, US is a difficult market for us because US has all the players, all the markets, and they don't like an Indian player to come there and sell it. Or European player, even European player that didn't succeed in US market. It was a difficult journey for Manish to take on that head-on bet with local players, and he spotted a white space. Upli Srinivasan and Manish spotted a white space. Banesh spotted a white space in that whole. So they are able to establish a first footprint in US market, and they have solution cloud. And American market is a very once you sell and implement for 5 players, suddenly market can shoot up substantially. So that's what we are seeing, that we took some time to identify what is the right space in which we can position ourselves in a company in America. And that required a huge investment. And I think we are seeing some silver lining right now.
Rahul, you've seen that we do land and expand. It's very important to make every implementation a successful one. And you've seen me always go deep into the account. So each of these accounts are marketplaces, literally. These are very, very large banks which we are breaking through in. So keep your support on with us. We will make it large.
Sure. Thank you for the color and best of luck and congrats on very strong numbers.
Thank you.
Thanks, Rahul. Next, Arun, we have Kunjan from First Global. Kunjan?
Yeah, hi. Can you hear me?
Yeah,
Kunjan.
Hi. First of all, congratulations on the great set. And just a quick question. There was a question and answer in the chat box. Someone asked about the decreasing promoter holding. I think there's a confusion because of the RSUs in the ESOPs, the percentage of promoter holding is decreasing. So I wanted to understand what is the annual equity dilution in terms of RSUs and ESOPs in our company. I know it is important for us to pay the employees since we are a product company and we are doing great in our business, but I just wanted to understand what is the annual dilution, and to support that, could we have a option for buybacks, which usually US companies does, so that our total overall equity position is intact and the dilution doesn't take place.
Yeah, so I think you can take it to total 10% of the ESOPs RSU, which AGM has cleared. Those are the RSUs which are there with us. 2015, 2016, 2018 schemes, we have RSUs available. And if you take annualized basis, it will be between 1.5% to 2.5% would be the increase. Okay, so that was the reason of promoter dilution. Okay, I didn't understand promoter dilution, so it's a percentage of it. So thank you very much for updating me. But that's a 1.5% to 2.5%.
So just a follow up on that. I mean, can we have a buyback of shares so that the overall equity is not diluted for everyone, for shareholders, for the promoters, for FIC, everyone? So just your thoughts on that.
Sure. We'll do it as soon as we are generating more cash, sustained manner. We can look at it buybacks, but not immediately. But our board is looking at it. So at appropriate time when the sufficient cash is there, buyback can be looked at.
Got it. Thank you. That's all.
Yeah. Praveen, that's okay? Or somebody else is there?
Praveen, you're on mute. Sorry, I'm not seeing. Praveen, you're on mute.
Okay, let's. Parveen, has he gone?
So he's on mute. He's on mute, I think.
Parveen, you are on mute. Yeah, there's another candidate, Vaibhav, I think is here. You can ask a question, Vaibhav.
Yes, next is a Vaibhav. Yes, Vaibhav, please ask your question.
Yeah, can you hear me?
Yeah.
Yeah, so just two small questions from my side. One is that if you can give us the number of sales people for last 3 years, sequentially, just wanted to know the trend there, direct sales people that we have. That's first question. Second, on the revenue, basically you have a different revenue recognition model for different operating structure like cloud and SaaS and everything. But from the perspective of the fact that for cloud and SaaS, whatever technology changes that happens, I think the liability rests with us to continuously update the product. Right? And if there is a substantial technological change that is there, then probably we might need to invest a lot in the product. Then how that is taken care of in the pricing, because pricing might be fixed upfront itself for next 6 years, 7 years, or what is the contractual period. So just wanted to understand these two things. That would be it from my side.
Because the contract is signed on 6 years basis, even my stack and scope is also defined in that 6 years. So normally for that period of time, the technology shift which has happened will not be available to that customer. So that's a typical way of managing the cloud. And if something is required, he has to pay separately, because as a contract, we have both the things there, price and fixed scope.
Mm-hmm.
So that's how we are protecting ourselves on commercial interest. On your sales system, I'll send it to you later on.
Okay, no problem. I think that's it from my side. Thank you.
Thank you. Now it's 6:30. Let's close the call. Yeah.
Arun, can we have a couple of more questions?
No, it's 6:30. I have another call to go. So.
Okay. Thank you, everybody. We are sorry that I'm not able to take all the questions. You can please write to us, and all the questions will be replied by us. Thanks for joining today. Thank you, Arun, and the management team also.
Thank you.
Thank you. Now you can unmute.